Meantime, the S&P coming off 3 straight weeks of gains after 3 weeks of losses, and now less than 1% from some new highs. The Dow's coming off the best week of the year, 4 positive weeks in a row. Let's talk more about whether the rebound rally can continue. Barclays head of U.S. equity strategy, Venu Krishna, has an S&P target of 5,300, joins us this morning. Venu, great to see you again. A lot of chatter this morning about whether or not people are lining up for a friendly CPI print this week. Are they betting too much on that?
What I would say is that the SPX returns sensitivity to CPI is extremely high, and it is negative. So in other words, if you do get a good print, in other words, inflation is slowing, then the market is going to rally a lot or react a lot. But if it goes the other way, then we have the different problem, which is going to fall a lot. So I think in aggregate, even though S&P's sensitivity to overall macro factors has somewhat declined, but the sensitivity to CPI remains very high. So that is the key point, which is driving the markets. It will also drive the 10-year rates and eventually percolate into valuations for equity. So I think it's worth keeping an eye on.
There are some notes on the street today arguing that when the signal is the greatest, it still points to disinflation, and where signals are the noisiest, it points to upside risk on prices. I wonder if you think that's a fair statement.
Listen, the reality is that a big part of the inflation battle, or the easier part, if I can say is that, has been won. But we are sticky at this point at 2.8% core PCE, which is what the Fed cares about. Now, in our view, for example, that decline or that improvement has indeed aided what we think the fair value of S&P outside of tech. The multiples for that is by almost 1.5 turns. But I think we are still in a territory which is unclear. So if you look at, you were talking about the consumer segment, one of the interesting things is, while people are talking about where inflation will go, one of the concerns which has cropped up is this stagflationary concern, for example, where growth slows and inflation remains high. Now, we think that's exaggerated, but I think it's going to show up in margins, and let's see whether we indeed make some progress on inflation going forward.
Just given the big run-up we've seen so far this year in stocks, and now it's 9.6% for the S&P, what is happening to earnings expectations from here, and where do you think they're most mispriced? What kind of sectors?
Yeah, so I would say that this earnings season has been extremely good. It has surprised on multiple parameters, and if you look at overall, for the biggest driver obviously has been big tech. So forward revisions are up over 17%, which is pretty stunning after the kind of results they posted. For the rest of tech outside of big tech, it's up around 6.5%. And for the rest of S&P outside of tech, it's up around almost 5%. So I think the earnings revisions are going in the right direction, which was somewhat sort of what we saw in Q1. The question really is, as we go forward, outside of tech, will the margin pressure be handled appropriately by companies? Because that is a lingering concern, and it is centered around the fact that the U.S. economy has been really pushed forward with the strength of consumption in the consumer. So if there are any cracks in that, that's going to start showing up. And I think the consumer segment, like you noted earlier, there is concern from managements of companies, even those who have posted good numbers, about some concern about demand waning and their ability to hang on to prices.
Hey, finally, Venu, are you under you feel any pressure to raise your S&P earnings target for the year, given what earnings season's done?
Not at this point. We would want to wait a little bit longer. So if you look at, Carl, where it is coming from, it's almost all coming from tech. And outside of tech, it is really, kind of marginal. So what we want to see is it broadening out to some extent. Now, we are happy that big tech continues to drag the whole market up, but we need to see it broaden. But I would say that we have noted that the risks are clearly to the upside. So our base case for S&P remains at 5,300, and we have an earnings number of 235, which is about $8 less than where consensus is. And in the big picture, consensus has not changed dramatically even after Q1. So no, we are not in a hurry to change our earnings number till we see how the rest of S&P outside of tech is able to handle the ongoing sort of margin issues.
Right. And then a lot of that depends on what rates do from here. Venu, thanks. As always, appreciate it. Venu Krishna over at Barclays.
Thank you for having me.